To the topic today. As Mary Lou said, we're going to talk about navigating business valuation in times of uncertainty. Two speakers for today will be myself, Melissa Bizyak. I'm the partner leading the Business Valuation Litigation Services Group. My partner, or my manager, partner in crime, Brad Matthews, will be joining me. Brad, 10 years plus of valuation experience. I'm 25 years in. I started here when I was 10. Hence the enormous experience. That's our vitals. I told Brad I was going to tell everybody one thing that people probably don't know about you, unless his mom is on the line. But Brad is a twin, and his twin is actually an architect down in Miami. So something interesting to learn about Brad before we head in. Feel free, though, to type in some questions that you have. We won't get to them today due to time, but Brad and I will be happy to answer them offline and potentially even set up meetings with you guys. So just to kick things off, doing valuation at this point is becoming a very complex exercise. Not that valuation was any less complex prior to 2020, but certainly dealing with some of the unknowns, primarily surrounding the coronavirus, or the Rona, as my kids have termed it. You know, we're dealing with a lot of moving parts. So some of the things that we're dealing with, both short-term, mid-term, and long-term, is the health and the economic effects of the virus. In addition to that, we're also trying to determine those impacts of the stimulus packages that were offered by Congress and the administration in response to the virus. And also, we're contemplating those potential future economic stimulus packages that both presidential candidates were on board with prior to the election. We're also dealing with short, mid, and long-term effects associated with the results of the elections and certainly other elections. Some of the things that people concerned about businesses and transitioning wealth, what they were concerned with would be certainly tax rates, those associated with corporate tax, capital gains rates, and certainly the estate tax, which both candidates had varying views of those tax rates. So the associated problems and the issues for business valuations that has been caused by the virus are a number of things. Certainly eroding of consumer confidence, slowing employment growth. We were seeing record high employment rates prior to 2020, and then with the outset of Corona, certainly dealing with huge increases in unemployment. Shrinking income as unemployment benefits expire, certainly a concern of a lot of people that were employed and no longer, or that may have been furloughed or laid off. As of yet, unconfirmed permanent changes in consumer behavior, trying to determine if and what is the new normal after this virus eventually settles. And certainly, and not unimportantly, is the uncertainty with respect to the virus and the vaccine. We did have an announcement, a positive announcement at the beginning of the week with a vaccine that had a 90% effective rate through Pfizer. Certainly this release was amid some areas of the country that were experiencing significant increases in the virus. Talking about facing the unknown, for many companies, the problem is longer-term solvency, giving possible fallout from the shutdown and potential future shutdowns, which we are still uncertain about on the horizon here. The specific unknowns present the most challenging issues for managing a company through a pandemic and beyond. Huge issues in trying to navigate through troubling waters and try to right-size companies during these times. These significant unknowns are certainly equally challenging for those that are like us, that are being asked to value these businesses for a myriad of purposes, and we'll talk a little bit about some of those purposes later on today. But some of the ones that we're going to focus on with respect to equity valuation, as the current circumstances might be presenting us with some opportunities. And specifically, we'll talk about gift and estate tax matters, litigation, specifically shareholder buyouts, divorces. We'll talk a little bit about that, and certainly business mergers and acquisitions, and how the current environment is affecting those valuations, and certainly presenting some opportunities. Before we jump into the heart of what we want to talk about today, I'd like to give you guys a brief refresher or primer on value. Just going back to the basics, value is always forward-looking. We really aren't, if we're looking to make an investment in a privately held business or even a publicly traded company, we're really not that concerned about how the company performed for the equity holders in the past. We're really concerned about how it's going to impact our investment into the future. So value is always forward-looking. Valuators will always focus on what is known or knowable at the date of valuation. Brad's going to take a deeper dive into that, because it's extremely important in this climate in strategically timing business valuations and focusing on that date of valuation. Valuation is fundamentally, it's an identification of risks and a quantification of risks, considering three primary areas. One, and most importantly, would be the expected future economic benefits derived from a particular investment. And in this case, we're talking about an investment in a privately held business. And that's usually something that we focus on free cash flows. You might say earnings before interest, taxes, depreciation, and amortization, EBITDA, but typically we're talking about those free cash flows that are available to equity holders at the end of the day. We also would look at the risk associated with achieving those economic benefits at the time that we expect to achieve them in the future. And then lastly, we will also look at the risks associated or attributed to a specific equity interest in a business, and based on those attributes of the equity interest. And namely, we'll be talking about discounts and premiums, discounts for lack of control, discounts for lack of marketability that are associated with equity interests in privately held businesses. So when we're gearing up to do our valuation work, we're certainly trying to consider the impact of COVID on businesses and where the economy currently stands. Many businesses are going to face a broad spectrum of challenges, some anticipated and some unanticipated. Some of those challenges would be supply chain disruptions, which we've seen certainly at the outset. I was in my office giggling this afternoon, and Brad came over wondering what I was laughing at. I was looking at COVID jokes, and most of them, believe it or not, were about toilet paper. So that's how I relate back to this. Certainly labor shortages, revenue declines, companies that are tied into industries that are suffering, certainly going to see revenue declines. Increases in bad debts, customers that might be unable to pay for certain services or goods. Reduced cash flow, the inability to obtain credit if the company gets to a position where their financial condition is not stable, they may have the inability to obtain some credit. And certainly something that we're seeing is the inability to continue as a going concern. So 3 steps in assessing value of a closely held business in the COVID world. First and foremost, we want to develop or try to develop an intimate understanding of the economic impact of the pandemic on the subject company in the current year, in 2020. How has it impacted the business? Just how deeply has the business been impacted? And believe me, we've been involved in the valuation of certain companies that haven't been impacted very much by the pandemic. However, we have been involved in a number of valuations of companies that have. After we understand what is going on at the time, we need to move on and try to develop an understanding of the effects of the pandemic on the company during a recovery period. I have in here parentheses 21, 22, 23. It might be longer. If you're talking about a company that is tied to the airline business, Boeing is saying 2023. I believe American is saying 2024 for a full recovery. So we're trying to gain an understanding of if and when that is going to happen for the subject company. And then from there, the last part is we want to develop an understanding of that period, regardless of when it is in the future, when the company is going to reach a level of stabilization, sometimes called a steady state. And that is, as Brad's going to talk about, part of the income approach where we would call a terminal year. That's going to be the year where we take the company in that steady state out into perpetuity if the company is considered a going concern. So applying that three-step approach is going to require some careful prognostication on the part of business valuators. You know, most economists and commentators are expecting a gradual return for the economy and to a level of normalcy. Certain industries, of course, probably will not see a gradual return, and even companies that are thriving in the COVID age, certainly their growth patterns are going to be very different than other companies. The challenge will be to develop a strong understanding of the economic impacts for 2020 and certainly into the future. It's not likely, as we had said, that history would be a proxy for the future during this time. Other things that we would be concerned with is what happens if a virus is delayed or if there's a severe second wave of the virus in 2021, which a lot of people have been talking about. We have had some positive news. However, it's still speculative as to when that will be rolled out and how that will be effective. So some topics we're going to cover this afternoon. Brad is going to talk about the data valuation considerations that are extremely important. Not only is it a definitional item of a valuation project, it is a very strategic item that you know, we need to have an understanding of in order to implement our valuation procedures. Brad's also going to talk a little bit about the income approach under valuation methodologies, and then I'll talk about the other two approaches. We'll talk about valuation discounts and what they look like in this current environment. We'll also talk a little bit about some other current issues that are impacting valuation, things that business owners need to be aware of as well as their advisors. I will talk a little bit about some valuation opportunities that are out there, and then we'll wrap things up and try to get you ahead of time for your transition into the PPP discussion.
Good afternoon, everybody. We're happy to be with you here this afternoon, albeit in a slightly different fashion than usual. Where I'm going to pick up the ball is talking about data valuation. And data valuation in any valuation engagement is critical because valuation is a point-in-time measurement, and value will change over time, whether positively or negatively. And a valuation can only consider and incorporate what is, as Melissa said, known or knowable as of any specific effective date, that our data valuation. So as it relates to 2020 and the year that we've had, most valuators believe that the impact of COVID should be included in valuations beginning in that time frame, that late February, early March time frame. Now, as it relates to events that occur subsequent to the data valuation, and because things are so fluid in the world that we live in right now, there are going to be a number of events that happen between the effective date of the appraisal and the actual release of the appraisal report. Those events that occur subsequent to the data valuation will not be considered directly in the analysis, although they will be documented and incorporated into the valuation report. They will just not be incorporated directly into our valuation analysis. Now, the chart I have up on the screen I like to use as an illustration. We're going to be talking about the efficient market hypothesis. So I know we have some attendees from the wild world of higher education, so please don't hit me too hard in the evaluations when this isn't exactly word for word, but the efficient market hypothesis, going back to the days of intro to finance, basically says that trading prices constantly change to reflect all currently available info, or I guess said another way, the price at any point in time reflects all of the information available. So people buying and selling shares of stock are using all of that current information to adequately price those shares of stock. So what that allows us to do is see when the public market signals when information has become available and should be incorporated into business valuation, or when that information impacts the values of business. So as you can see, based on the market results throughout the year, it's around that late February, early March timeframe when the public markets started to go down. Really, it's the incorporation of a number of things, but primarily the uncertainty surrounding the coronavirus. So as evaluators looking at privately held businesses, that signals to us that's when we should be looking to incorporate information into our valuation analysis. Now, as Melissa said, valuation is a process of risk assessment as of any data valuation, and that is risk assessment using all available current information. So valuation is point in time specific. So in 2020, a data valuation carries with it many, many issues because of how fluid things are in determining what is known or knowable as of that specific data valuation. Earlier dates of valuation, and I'm thinking, March, April, May time frame, would seemingly have the greatest amount of risk. And the reason for that is when there was the greatest amount of uncertainty in terms of how our economy was going to be impacted by the coronavirus, when we were going to be able to get some type of resolution, either whether that be some type of vaccine or otherwise. Also, outside of just the coronavirus, and the other big part of 2020 is the presidential election, and a data valuation subsequent to the release of the results has to incorporate any information that you can glean as a result of the results of the election. So as we sit here today, and we're gonna start launching our first poll question, but in honor of the Masters going on right now, we are going to do a playthrough. We're going to keep talking about the current state of the election process. So as we sit here today, if our data evaluation was November 12th, 2020, what would we need to incorporate? We know we have a president-elect coming from the Democratic Party. We know the Senate race still is not settled, and so we don't really know what type of changes may be made until we get the results of that Senate race. As Melissa said, there's a potential vaccine available out there, but there's still uncertainty in terms of the timing of the release of that vaccine, the true ability of that vaccine to combat the virus, and when the general population is going to be able to receive that vaccine and allow us to become a little more immune to the virus. So shifting gears now, we're going to go through each of the valuation methodologies. And anytime that we give a presentation about valuation, we always talk about the three primary methodologies. They're the same no matter what kind of economy, no matter what type of appraisal, and that is the income approach, the market approach, and the cost asset approach. Starting with the income approach, you'll all recall that the income approach is built upon this idea that value of any investment is really the value of the future economic benefits brought to present value using a discount rate commensurate with the risk inherent in that investment. Now, this aligns with the idea that Melissa said before, that value is focused on future performance. We don't really care what happened yesterday. We primarily care about what's happening tomorrow, the next day, and every day after that. So the primary drivers for calculating a value in the income approach, simply a numerator and a denominator. The numerator being that future economic benefit stream, usually calculated in cash flows, and the denominator being the risk associated with the realization of those cash flows at the time and in the amount that we are forecasting. So value at any point in time is really rooted in that expected future performance and the risk associated with it. And when we think about risk, you have to, encompass risk in, is it a booming economy? Is it a recession? Or, is it a global pandemic? The two primary methodologies under the income approach, again, each are based on future expectations. The first being the discounted future cash flow method, DCF method. In this method, we're going to be looking at a discrete period of financial forecast. We're going to be bringing the value or the benefit stream within that financial forecast back to present value, and then we're going to be calculating a terminal value, which is really the value of every sequential period after those discrete forecasts that we specifically look at. Alternatively, the capitalization of future economic benefit method, the CCF method, is just a single period calculation where the growth in that economic benefit stream, that single period economic benefit stream, is expected to be linear over time. Now, some venues prefer a CCF over a DCF because they believe forecasts are unreliable. But we always like to point out in this instance that a CCF is a forecast. It's just forecast of a single period with the assumption that growth is linear rather than looking at a multi-period forecast where we can have some nonlinear years capped by a point of stabilization where we believe growth will be linear. Now, looking specifically at the numerator in the income approach is going to be those future cash flows, that future economic benefit stream. Now, future revenue and expenses in many cases will experience fluctuations from historical results. And that statement is true even outside of a global pandemic, but it's even more emphasized when we have times of uncertainty that we see right now. So what does that mean in terms of what we're going to need to do for an income approach? There's going to be an increased emphasis placed on management forecasts. Now, we know we don't have any engagements where we don't get to the point where we're having a conversation with management about how difficult it is to put forecasts together. And we completely understand and appreciate that issue, the difficulty. But really, the risk associated with the business is best handled in putting together those forecasts. It's a lot more concrete of an answer if we're able to put together financial forecasts taking into consideration the best available information as of that date of valuation, and then bringing those back to present value. It is incumbent on the valuator to make sure that those forecasts are reasonable. They test those reasonableness considering the strength of the industry, the state of the economy, and again, what is the best available information as of that specific date evaluation. Now, switching over to the denominator. Denominator is that discount rate which is selected to align with the relative risk associated with the investment in the subject entity. It's really the rate of the return that an investor would require, understanding that there are alternative investing opportunities. So the discount rate must consider all of the factors that management incorporated into their forecast. And again, what is the risk associated with achieving those cash flows, those forecasted cash flows, in the amount and during the times at which we have forecasted. Now, during volatile times is the topic of conversation today. Risk return considerations are even more important as investors are generally risk averse. So the focus on the risk side of things, the denominator side, is even more critical. So this is a formula, one of the most recognized formulas for calculating the discount rate. It's the primary model for determining the discount rate called the build-up model, and it illustrates that required rate of return that we're aiming to calculate can be calculated by layering on rates of return measured from alternative investments. And all this is layering on those different rates that we can go out and measure. The four pieces: the risk-free rate, usually looking at a 20-year treasury bond, a long-term government-backed bond. Layer on top of that equity risk premium, being what additional amount of return do I require for investing broadly in the stock market. On top of that, if I were going to invest broadly in just the smallest companies on the stock market, what additional rate of return would I require to invest on the small company side rather than diversely across the spectrum? And then one last layer being the only subjective layer, what additional rate of return would an investor require to invest in the specific company that we are looking at, that being return over and above investing diversely in small publicly traded companies. Layering all four of those together is what will allow us to come up with that required rate of return for any specific company. So some current issues in the denominator. As we've seen with many businesses, there is additional risk associated with the receipt of those future cash flows. And what that does is, as an investor, I'm going to require an additional amount of return to compensate me for that additional risk. We also know that the yield on the 20-year Treasury bond during 2020 is abnormally low. And if you think about, if we're layering these different pieces together to come up with our discount rate, if any one of those pieces is low, that means our discount rate is going to be low. A low denominator in any simple equation is going to lead to an increased overall answer. So with the 20-year Treasury bond being low, really what that does is artificially inflates value. So it's something that needs to be considered when putting together these build-up models. Most evaluators are adding risk into the company-specific risk premium, but have to be careful to ensure that that risk is not double counted either in the buildup of the cash flows or alternatively in the discounts that we'll talk about later. Now we talk about the method selection between a DCF versus a CCF and what would cause one to choose one method over the other. It's really what is the expectation for the future growth of the business. The use of a single period CCF poses a variety of issues because, again, that model assumes that the business is going to grow in a linear fashion. And I know that there are many businesses during this time period that aren't going to experience linear growth in any short period of time. The subject company's history may have little relevance on the future expectations. And again, in the income approach calculation, what we're primarily worried about are those future expectations. So the best solution for this issue, again, is going to be to use that multi-period DCF. It's going to allow for the inclusion of varying levels of growth during some short period of time, reaching a point of stabilization where we can make the assumption that the business will then grow in a linear fashion. And again, although it's difficult to forecast, especially in times of uncertainty, it will actually produce a more reliable answer than trying to use that shortcut CCF method with the linear growth assumption. So to kind of wrap up the final thoughts on the income approach, application of this approach during dates of valuation post-COVID will continue to be challenging because of all of the uncertainties, both on the cash flows of the business as well as the riskiness associated with any operating businesses. The changes, both regionally, nationally, and even globally for globally competing firms, are material and fluid, so that really emphasizes understanding what is known or knowable at any effective date. Adjustments must be made to both the numerator and the denominator in the income approach calculation, but care must be taken on the side of the valuator to make sure those aren't double counted. So as users of the valuation, I encourage all of you to make sure that you're verifying with the valuation professional that there isn't overlap in any of these different areas.
Thanks, Brad. Talk a little bit about the market approaches. I think most of you who have heard us speak before are aware that we do, for operating companies, we're primarily focusing on an income approach as Brad had talked about. So it is really important that we go a little bit deeper into that. Market approach is an approach that's really predicated on the concept of comparability. The price of a particular asset or an investment is going to be based on the selling price of a similar asset. Just like if you want to sell your house, you're going to go out and look for homes that are comparable in order to derive an estimated sales price. So the basic equation that we're going to look to under the market approach is this here. The equity value, the value to the shareholders at the end, is going to be the price of the comparable company or asset divided by the particular parameter. Most oftentimes we see EBITDA, earnings before interest, taxes, depreciation, amortization. Sometimes we see EBIT or even revenue. So we develop that multiple by dividing the price by whatever parameter we're using. And then we multiply that multiple times the subject company's parameter, so EBIT, EBITDA, or revenue. At that point, we have the enterprise value of the company, and we will subtract debt in order to arrive at the equity value. Equity holders take on the most risk in a business and capital structure, so therefore debt associated with senior lenders will be subtracted first. Using a market approach can lead to incorrect conclusions of value due to a number of things. First and foremost, limited availability of quality data. There are two methods that I'm going to talk about under the market approach, one of which is plagued with this limitation as to the amount of data that is available that helps us in assessing whether or not that particular transaction and therefore multiple is similar and can be applied to our subject company. Certainly difficulty in properly assessing and applying the data, and I'll connect the dots on that one in a second here, but that's extremely important during times like this. And then misapplication due to lack of sufficient similarity. You need to ensure that what you're using as a multiple for a subject company is sufficiently similar. One thing that we see quite often is a subject company or a subject transaction that really lacks significant similarity points with the company that we're valuing, and it's really difficult to kind of put a stake in the ground and say that this is the value based on a market approach that's providing a multiple that is really not reliable. One of the methods that we look to under the market approach is called a guideline public company method. And essentially, what you're doing is you're going out to find, hopefully, a population of publicly traded companies that are sufficiently similar to the company that you're valuing, and you would apply that resulting multiple to the subject company metric or parameter. And sometimes it's very difficult. If you have a very small privately held business, it's very difficult to use a very large, well-capitalized, publicly traded company multiple and apply that blindly. Public company multiples may not be entirely relevant to a subject company. A lot of small to medium-sized businesses, it may not be relevant. That has to be a discernment on the part of the business valuator. Multiples that are applied to historical earnings may no longer be relevant. There are a lot of multiples that are applied to future earnings and cash flow, where you'll see future multiples that are applied. So those are things that must be considered during times like this. And then certainly proper application of this method will vary depending on the date of valuation. So before pre-COVID news, we will be able to apply this method pretty much in the same way that we were providing or applying it in the past under normal guidance. After late February and the post-COVID news, valuation using this method will require some considerable forward-looking multiples, some consideration, and certainly some care in applying that methodology. Another method that we use under the market approach is called a guideline completed transaction method. And that can be completed transactions both in publicly traded and privately held companies that are reported to various databases by business brokers and certainly sellers and buyers. This will focus on value indicators completed or produced through completed transactions. So once the transaction is closed, certain metrics will be developed and converted to multiples. So we'll be taking the price and looking at trailing 12 months EBIT or EBITDA in order to derive a multiple. Understand that all of these transactions that happen are not going to be decided based on a simple application of a multiple. It's going to be a lot of due diligence and a lot of focus, and that multiple is pretty much an afterthought in order to kind of give you the cliff notes in terms of how the transaction turned out. But valuators will want to carefully consider the use of multiples that are derived from transactions occurring during and in the wake of the crisis. Typically, we're using the market approach and the methods thereunder as a confirming rather than a primary methodology. In applying the guideline company transaction method, some of the issues that we're facing in certainly during 2020, we're seeing very few transactions. Reconciliation of pre-COVID-19 transactions and certainly the few post-COVID-19 transactions are difficult at best. And it's extremely difficult to determine how best to modify those multiples for the impact or effects of COVID-19. Some of the issues that we face implying the guideline public company method, sorry, these are kind of a little bit out of order, but as of October 31st, the date that we were writing these materials, the stock market values have held fairly strong, and actually recently the market surged at the beginning of the week with the release of the news that Pfizer had a vaccine that was 90% had a 90% effective rate. We've seen some slippage the past couple of days certainly with the numbers of COVID climbing. So interpreting the public market response to the economic effects is certainly necessary if we're going to apply that method to ensure that the subject company will act similarly. If not, you abandon applying the method, or you make certain adjustments. And a lot of those adjustments will actually be subjective and based on valuator judgment. Last approach I want to talk to you about is the cost asset approach. Typically, this is something we usually mention and skip over, but this is an approach that we're incorporating quite frequently now in valuations in this post-COVID world. And this approach is basically a determination of value that's predicated upon an assessment of each asset that's held by a business and assessing those liabilities associated with those assets on the company's balance sheet. We typically use this most often when equity value is based on underlying assets, appreciation of underlying assets, such as a holding company, real estate holding company, for example. Now, we're actually considering the cost asset approach because we're finding certain situations where value under an income approach on a going concern basis is less than what we would get in an orderly liquidation. So something to consider in terms of valuation, some things that are a little bit different now, but that's going to move us into polling question number 2. And as you answer that, the only thing I would say that is very different than in the past is selection of approaches is going to be a little bit more unique now. You're going to see more use of a cost asset approach for operating companies that may be having some issues or may be faced with a situation where they're worth more dead than alive. So just a little nuance that you might be seeing in valuations. I'm going to turn things over to Brad, and we're going to shift gears a little bit and talk about valuation discounts.
So when we talk about, so what we've talked about so far, the methodologies for calculating value, we've calculated the value of the entire business. Now we need to use valuation discounts to bridge that gap from the value of the total company to the value of that specific ownership interest that we are analyzing. So discounts are required in order to account for the specific attributes of an ownership interest in a business. So as Melissa said before, the discount and the DLOM are the two that we're going to look at, and they're used to account for the value detriments of that specific ownership interest related to marketability and control. Numerous internal and external factors will affect the application and the size of each of those discounts, and those are going to be facts and circumstances specific depending on the company and the structure of the ownership. But know that there are no prescribed ranges of discounts. Historically, sometimes evaluators would say that it is within a certain range, but as data analysis becomes more and more sophisticated, that idea that there is a standard range is really starting to go out the window. So starting with the discount for lack of marketability, defined as an amount or percentage deducted from the value of an ownership interest to reflect the relative absence of marketability. What that means is at owning a privately held business, we cannot immediately liquidate it for a guaranteed price. Privately held businesses generally lack that ready market that you would be able to see with publicly traded stock. So the COVID-19 environment specifically adds greater risk and likely makes marketability even more difficult. Melissa said when she's talking about the market approach, we've seen fewer transactions of privately held businesses. There are fewer buyers and the lower likelihood of going through a sale transaction. There have been an increase in price volatility and uncertainty surrounding the sustainability of business operations. So what does that do? It deters buyers from investing because of the risk associated, the increased risk associated with the business. Expected distributions and dividends heavily impact that discount for lack of marketability because it can make a business more or less attractive to that hypothetical investor that we are looking at. So if you have a decrease in distributions, that's going to increase your discount for lack of marketability, decrease the overall value of that subject ownership interest. And in times of uncertainty, really what you're looking at is the likelihood of decreased profitability, the decreased ability to make distributions, fewer buyers available and willing and able to purchase ownership interest in business, all of which are going to have a general increase on the discount for lack of marketability. The issue being that increase becomes more and more difficult to measure and becomes more subjective on the point of the evaluator. The discount for lack of control, alternatively, again defined as an amount or percentage deducted from the value of an ownership interest to reflect the relative absence of control perquisites. So the attribute of control, when you think about it, makes an ownership interest more valuable because a controlling owner has the ability to either mitigate risks associated with the business or make changes that would allow for an increased return, increased profitability. Increased return, decreased risk is going to lead to increased value. A non-controlling ownership interest does not have the ability to do this, hence the discount. Often in private companies, a minority shareholder faces a greater risk that a controlling shareholder is not optimizing that risk-return aspect of ownership interest in any investment, thus creating that value detriment. And during uncertain times, it's even less likely that a minority shareholder is being adequately rewarded for that risk tolerance that they're undertaking. So kind of going over some other general current issues affecting valuation, although we've kind of threaded them throughout our presentation here. The CARES Act, we're not going to go over this in detail because we do have multiple presentations coming up discussing it, but the impact of the different aspects of the CARES Act needs to be considered for dates evaluation during 2020. For just by way of example from a few of the different pieces of the CARES Act, the PPP loans, if it's assumed that a loan is going to be forgiven by the government in the valuation world, we're going to exclude that outstanding debt from consideration whenever we're calculating the value of equity. As another example, when you look at the ability to utilize NOLs, previously we were not able to carry them backward, only forward, and apply them to 80% of taxable income. Now, with the ability to carry it backward and the elimination of the 80%, we're able to more readily recognize the benefit of that NOL. All of these things need to be considered by the valuation professional whenever looking at dates of valuation in 2020. Finally, touching base on subsequent events. With things so fluid and changing so rapidly during this year, subsequent events are other items that need to be documented by the valuator. Again, it goes back to this idea that what is known or knowable as of the date of valuation, and that's what is factored into the calculations itself. Any subsequent events need to be disclosed and need to be addressed, but cannot have a direct impact on those calculations. So all of these different items that we've talked about, depending on when they became knowable, will determine whether or not they are incorporated into the calculations themselves. So we are going to launch the third polling question, and while we do that, I just want to put out a reminder that we do have two more CPE Day sessions, one a week from today. That's going to be a double header on tax topics. We're going to take a break for the Thanksgiving holiday. I know all of you would be very excited about hearing the ANA update during Turkey Day, but we will allow you to have your time with your families. We're going to pick it back up December 3rd, where we're going to have our ANA update, and then we're going to have a discussion on fraud prevention as well.
Thanks, Brad. Last few minutes here before we wrap up, I want to talk a little bit about some opportunities. First and foremost, we'll talk a little bit about estate planning opportunities and kick it off with a quote that I like. Be fearful when others are greedy, and greedy certainly when others are fearful. We're at a place right now where the global pandemic and the current political climate combined to create significant estate planning opportunities. Even as we stand today with President-elect Biden, we're unsure as to where Congress is going to head. If it's going to be a split Congress, some of the tax rates and limitations that President-elect Biden is proposing may be tempered a little bit if the Republicans are staying in the Senate. So one of the things that we're doing a lot of is gifting strategies, because we're talking about potentially going from an environment where the IRS just released, I think it was 2 weeks ago, the 2020 gift and estate tax exemption, which was at $11.7 million per individual. If it's a situation where things change and Congress is not split, we could go down to a $3.5 million per person exemption, and seeing the tax rate go up to about 45%. So at this point, the date of valuation is going to be strategically chosen, typically by legal counsel and the taxpayer, the individual, and articulated to us. And some of those factors that are certainly impacting the date of valuation selection is going to be investment risk is greatly increased, of course. And as Brad talked about, valuation discounts, and namely the discount for lack of marketability, has increased. And certainly current tax environment, which I just spoke about, could potentially change. With respect to mergers and acquisitions, we are seeing a transition from a long-running seller's market to one that's favoring buyers. Although you're probably hearing a lot about dry powder. Dry powder can be described as a company that keeps a lot of cash and convertible to cash securities in time to weather bad times. But it's also a term that you hear from PE firms that they have funds available to deploy if they find an attractive investment. And they do have dry powder, but I would say that they're going to be a little bit more selective certainly in their investments, and they're certainly not going to be paying the multiples that we've seen in the past. So this environment is really going to make value creation in a deal much more critical than ever. Some of the things that we'll see is an increase in sellers that will be willing to offer financing to bridge some capital needs that may not be currently available from banks or other third parties. We'll likely see many more earnouts, contingent consideration involved in mergers and acquisitions. Exit planning. Exit planning is still going on. However, exits from a business may be delayed. Transactions may be put on hold for now to a kind of a wait-and-see method. And additional runway may need to for planning purposes on behalf of the current owners. But also current owners may need to explore some other planning options that will be available to them in lieu of getting some high multiples like they've seen in the past. So just to wrap things up, some final thoughts that we have is certainly the value of many privately held businesses will be negatively affected by the onset of the coronavirus. At one end of the spectrum, we will have companies that are experiencing relatively minor or even a temporary decline in value. Well, unfortunately, at the other end, we will see a decline in value, and that might be significant and potentially permanent, where we see some businesses, and a lot of them on restaurants, hospitality, that we see going out of business at this point. As Brad had noted, an opinion of value will include an assessment of a host of factors. All of the factors that we discussed today that need to be considered both in conjunction with the future cash flow, as well as an assessment of risk, as well as an assessment in the discounts that are available to the subject interest we may be valuing. Also, as Brad has noted, valuation is going to be predicated on what's known or knowable as a specific date. So that valuation date is extremely important and can be strategic. And understand that value can change over time. And certainly in this environment, value can change rapidly over time. And certainly, as we talked about, consideration should be given to those opportunities during this time because there are many. And there will be transactions, there will be estate planning, there will be exit planning and other opportunities for business owners at this time. So Brad and I would like to thank you for your time and your attention. Please fill out the survey. I'm going to transfer things over